are coming in. What are you picking up from this counter?
Well, definitely one that's finally seeing an up move after a long time, and this is on the back of approval for the joint venture with HKC. Now, this is a PN3 approval received by MeitY, and it is something that the company had already guided for as expected in Q4, and now that it finally has come. And mind you, we are still awaiting the approval for the joint venture with Vivo. It's an important part of its plan to have margin accretion over the next couple of years. But to talk more, if this is the right time to look at this particular counter after the volatility that we've seen, we've been now being joined by Ms. Renu Baid Pugalia. She's a Senior Vice President Research at IIFL Capital. Ms. Pugalia, very good afternoon to you, and thanks so much for joining in today. Let me put across and pose, the first question then on this particular approval that has come in now. We've largely seen that it is something that the management had already guided us, but the key question then, a lot of numbers being thrown around of a joint venture of 74% stake that the company has in this. What is if the revenue accretion as well as the margin accretion that you are penciling in, just not in the near term, but also maybe in FY28, maybe in FY29, with this approval now coming in for the joint venture?
So point number one, for the mobile smartphone phase 26 was the sunset year with respect to the PLI scheme. So increasingly investors and company also has been working towards what would provide the next leg of cost competitiveness. And Dixon for the last 1.5-2 years has been closely working with various supply chain partners to get a little more deeper into the value chain. And this JV announcement was on the same lines in terms of deepening their presence on the display module side. So the PN3 approval was awaited for a long time, and fortunately it's come around at the same time the plant was expected to commission. So company was expecting to complete the capex and plant commissioning in early part of fiscal 27 itself, so that it goes up and running through the year. And by the time the facility is fully scaled up, it will help to provide cost competitiveness and improve the costing structure and look at smartphone segment. Not just for smartphone, the JV is also for notebooks and tablets as well. So to that extent, on the component PLI, they tend to benefit in terms of the incentive structures, and also the absolute margin on the component side. For example, display module is a double-digit margin profile for them. So while one would say, yes, almost 2/3 of the business volumes, nearly 70-75% would be for captive consumption. This will help to bridge the gap between the absence of the PLI incentives on the mobile phone and to some extent the cost savings coming in from the component level. So the stickiness with customer and the value accretion which Dixon provides will remain sticky with the kind of value addition that they're doing on the component ecosystem for the electronic products.
Ms. Pugalia, is the expectation that this business, while Dixon operates at roughly around 3.9 to 4% margins, with the display business specifically, the asset turns are much higher, roughly around 7 to 8 times. You see also margins traditionally for players who operate in this business as around 15 to 16%. But do you expect that this business will also have similar for Dixon as well? And do you expect that FY28 could be a year where we see meaningful margin accretion coming in rather than FY27 at this point of time?
So, well, yes, on the component level side, the profitability is double digit, and I think management also has been guiding for the same. But one also has to look at the perspective that these components, almost 75% plus, will be going in for captive purposes for their own products which they are assembling on the smartphones as well as notebook side. So as I mentioned, that higher margin contribution that they're coming not entirely will come to the P&L, but it will also help to bridge the gap and pass on some of these savings to customers and improve the cost competitiveness and ensure stickiness on the business volume. And the remaining a quarter of the business volumes which they will be selling up in the third party open domain, that will directly add up in terms of incremental EBITDA. So while I think the company is definitely optimistic that beyond the cost savings, they'll be able to retain the profitability on the component JV structure, which in their view should help margin improvement. But even if we assume that the PLI extension doesn't come through for mobile phones, this in my view is technically a very strong reason to ensure the cost competitiveness is maintained. So yes, for FY27, there would be some likely impact of maybe up to 50 basis point on the margin side for mobile smartphone PLI, mobile smartphones for them. And that should broadly recover back in 28 with savings coming in from the HKC JV for them.
Right, and Ms. Pugalia, the management has of course highlighted that the longer term target of going from 4 to 5.5% margin continues to be through, and a target that they look to achieve. But could you give us some perspective that at this present juncture, what is Dixon's current bill of materials essentially, and where do you expect? Because the estimate is that it's roughly around 17 to 20% right now. And with the display module coming in, there'll be the first phase of that, and then the camera modules will additionally add that as well. I don't know if all these numbers are already in because the HKC approval has just come in this morning. Could you give us some perspective of where do you see that value addition to go? And is the expectation of 5.5% margins maybe by FY29? Is that something that you're penciling in?
No, I am not penciling in my numbers to become 5.5% in fiscal 28 to 29 for the moment. Relatively, we have been more conservative on the profitability side, especially in the current environment where most of the OEMs on mobile phones, especially in the economy segment, themselves are struggling. So to that extent, we have left that cushion open. We need to see how the overall bargaining moves between brands, OEMs, and here with Dixon in terms of give and take on the profitability side. But definitely from the margin dip that we're expecting in fiscal 27, 28, we're expecting margins to improve back to 4. Now, whether that 4 becomes 4.5 will also depend on the kind of volume scale up, which would happen in their main EMS that they're doing for mobiles as well as for laptops. If you look in terms of revenue contribution, the HKC numbers initial years expected to be in 20-25 billion rupees, and thereafter able to scale up to close to 50-55 billion on full scale. So to that extent, the revenue contribution in absolute terms from the component PLI is lower than the kind of revenues that they're expecting from the main OEMs, where typically the margin mix tends to be in 2.5 or up to 3 percentage point level. So a combination of the mix will also vary. At the onset, we would rather look at how the cost competitiveness is improving,
right?
How the company is able to hold back on their customers and deepen in the value chain, rather than looking at optimistic margin numbers at the onset.
Got it. Just as we wrap up, if I can just squeeze in one question and if possible, a quick answer as well. The Vivo JV is something that has not come in yet, but do you think that this favorably puts it into a position? I know it's a difficult ask right now, and your current, your target price and your rating on the stock as well.
Well, Vivo and HKC JV both are two different JVs for different purposes. The Vivo JV has been under process. There is no clear yes or no yet. In the analyst and management guidance, it's partially already baked in. So the timely approval of the JV or the under PN3 will help ensure that there are no gaps on the numbers and delivery as we progress through fiscal 27-28. If there are material delays, there could be earnings risk. Or we need to see how does the company maneuver with respect to an alternate route. Instead of manufacturing in a JV format, it could be done on an outsourced EMS business model. Few of those routes need to be worked out, and we need to wait and watch how the company and the management works on those levels.
Right.
We like the name. We have an ad recommendation on the stock with a 15% upside from current levels.
Well, thanks so much for that, Ms. Pugalia, and look forward to our next conversation as always. That's the view coming in on Dixon from IIFL.